Good afternoon again. It's still Thursday, January 22nd. We're going to continue with our briefings. We now have private passenger automobile insurance affordability, telematics, and updates on Maryland Auto Insurance Fund. And at the table, we have Al Redmer, Executive Director of the Maryland Auto Insurance Fund, and Devon Brown, Government Relations Manager. Gentlemen.
Well, good afternoon, Madam Chair, Vice Chair, and members of this great committee. As the wonderful chair has said, my name is Devon Brown, and I am the Government Relations Manager for Maryland Auto Insurance. As you guys know, Maryland Auto's role is to provide automobile insurance to Maryland residents who are unable to attain it in the regular market. And so we serve as a safety net for those who can't get insurance. And we ensure that we, provide insurance to and coverage to keep Maryland's roads safe. And so joining me today, we have a person who needs no real introduction as Executive Director Al Redmer, who will be giving our presentation. We also have behind me Joe Danahy, who is a member of our General Counsel. We have our Chief Operating Officer, Dave Pfeiffer, and we also have our Chief of Staff, Colleen Duval. And now I will turn it over to Mr. Redmer.
Great. Thank you, Devon, Madam Chair. Mr. Vice Chair, members of the committee, as always, it's a pleasure to be here for my maiden voyage in 2026. You know us well. You've heard a lot of this before, so I'm going to be unusually brief and just hit a few highlights and a couple of updates. Just to expand a little bit on Devon's introduction, as a reminder, we can't sell everybody insurance. We can only offer insurance to folks that have either been canceled by their current carrier, or if they're shopping around and they get turned down by two carriers, we can then offer them coverage. We are an independent, non-budgeted agency on the insurance side, no state, special, or federal funds. As an independent agency, we're not part of the state personnel system. We've got currently about 178 insurance professionals. If you look at our folks and you look at our organizational chart, it looks very, very similar to any other insurance organization. Being independent, we don't have the Attorney General representing us. We have a General Counsel. And we also have in-house and outside counsel for any claim-related matters. Generally, we are regulated by the Maryland Insurance Administration in the same fashion as other insurers, as you can see in front of you. Additionally, we're not subject to audits from DLS, so we have an independent auditor that conducts compliance and fiscal audits. Additionally, every year, we have a robust external audit that takes place. While we're not a budgeted state agency, we do provide budget information to DBM and DLS every year. If you look at the projected financial results for 2025, and I use the word projected intentionally because of how accounting works with insurance companies and reserving and those types of things, we will not have the final budget numbers for another couple of weeks. But I'll draw your attention to net written premium. 2024 was $128 million and some change. We saw a significant decrease to $93 million in 2025. Also saw a significant decrease in earned premium as well. Moving on, our operational results. It's important to note that a lot of the folks that we insure, probably more than half, are with us because of financial challenges. because of a variety of reasons, both rate increases that we've taken and a softening of the marketplace. We saw a deterioration in our policy count by almost 35% with personal auto, and saw a significant decrease in policies in force as well. I'll also point out that we've seen a dramatic shift in those folks that buy liability-only insurance. So in 2023, 62% had liability only. That has blossomed to over 78%. And what that tells you is that there are folks that are struggling financially. They desperately want to do the right thing and keep insurance, but they've got to lower their cost. So they are, getting rid of comp collision, those types of things. So they're doing what they can to stay insured. I'll also point out, the churn that we see is significant. Our cancellation rate has always been over 50%. The average number of days in force. So in 2023, it was 188 days. Last year was 173 days. So on average, somebody comes to Maryland Auto, they have no place to go. They get a policy with us, and they cancel that policy within 173 days. Now, some of those folks that cancel, they cancel because maybe now they qualify for the standard market and they go with State Farm or Geico or whoever the case may be. But the rhetorical question is, how many of those folks cancel, but they're still driving around uninsured? Some good news. You'll recall up until a few years ago, we were limited to the kind of installment billing that we could offer. And, this body, the legislature, allowed us to have a more flexible installment billing program. And what used to be 2% of our policyholders is now just about 20% of our policyholders. And even better news is there's a lower cancellation rate on folks that are paying with the installment billing as well. So if you look at the chart in front of you, when I arrived at Maryland Auto in May of 2020, we insured a little over 30,000, almost 31,000 personal policies. Ironically, on the last day of December, it was 30,000 policies. But look at what happened in between. Now, again, we're restricted. We can't go out and seek coverage. We only get what's left over. So May of 2020, when I arrived, it was, I thought, at the end of the pandemic, and the state, as you recall, was shut down. People were not driving, and if you're not driving, you're not hitting things. So the amount of claims that all insurance companies paid out dropped dramatically. And because of that, the other carriers got much more aggressive in seeking market share. So they did two things. They lowered their premiums, but more relevant for us is they loosened their underwriting. They were taking risk at the end of 20 and 21 and early 22. They were taking risk that they would not have taken a couple of years before that. So as a result, more and more folks left us and went back into the standard market, and that's great. That's why we're here, to be that safety net. But then what happened was the economy opened back up again. People started driving again, and as you know, driving around the state of Maryland, the demolition derby is back on. People are driving faster and crazier than they ever have. Then we had all the supply chain issues where the cost of repairing cars went up significantly. So what happened is insurance companies around the country, not just in Maryland, around the country, began hemorrhaging money. They were losing money because those risks that they took that normally they wouldn't have taken, they went out and started hitting things. Their claims went up. Their loss, it's historic amounts of losses. So as is always the case in most industries, there's a whipsaw. I don't say they overreacted, but they significantly reacted. So what they did was they drove up their premiums, but again, more importantly for us is they tightened up their underwriting. They got much more restrictive. They weren't appointing new agents. They weren't advertising on TV. They didn't want your business. They needed to fix their losses first. So we saw a dramatic increase in it. Now, again, we're not doing anything differently, but we saw our business more than double over an 18-month period as the rest of the market said, we don't want you. And again, that's okay. That's why we're here. So as you know, last year we triggered an assessment. That assessment mechanism has been around as long as we have, 50 years. The Maryland Auto Board certified an assessment of a little over $19 million. Those are invoices that went to the rest of the carriers in the marketplace. And then the carriers had to send a check that ultimately went into our surplus for an amount based on their market share. So if you had 3% market share, you paid 3% of the $19.5 million. As you'll see on the slide, that equated to $2.96 for every $1,000 of premium. Which I feel pretty good about myself considering the 2.75% health insurance increase going on. So we will have an assessment again this year based on the December 31st results. We can't tell you what it's going to be until we close the books, but we think it's going to be at least a few $1 million less than the assessment that we did last year. The assessment and the recoupment is it's basically the same information from last year. So again, if we go to look at our affordability index, again, this is something that we've been doing for a number of years. Our mission, our mandate, 40 years in the legislature, is to consider affordability when creating rates. And the what I'll call an insignificant assessment that we did, I believe provides incredible value to all of the policyholders that you represent. Our effort to look at affordability and keep drivers insured. If you go home and you blow the dust off of your old car insurance policy, you'll see that we all pay a certain amount for uninsured motorist coverage. And that average in Maryland is about $60 or $70 a year. If you go to DC, where they don't look at affordability, their uninsured rate is much higher. They pay about double what we do. Again, I believe that's a tangible benefit that we provide everybody. The affordability index, that we've talked about before, we're in the process of seeking to modify that and have it be based on the finances of the individual policyholder instead of their geographic area. But it is significant, and if we had to eliminate all aspects of affordability, it would require a rate increase of between 30 and 50% in some low-income communities. So I'm sure, obviously you're going to hear from the Insurance Administration in a little bit. We had an order issued in December of 2024 that required two things. Required us to modify the mechanism that we use to look at affordability, and we are doing that, and we'll provide an update report and plan to the MIA before March 1st. The other thing that it does is it requires us to have adequate rates by the end of 2026. Originally, at our request, that was delayed to 2027. So the issue of adequate rates. What that means is we have to collect enough premium to pay all of our claims and all of our expenses. And the reason that's an issue is when the legislature told us to look at affordability, they left in statute a requirement that all carriers have adequate rates. So at the end of the day, other carriers can do that, but because of the population that we serve, we can't, because we can't go out and write profitable business to offset the unprofitable business because of the restrictions that are on us. So, but you know, the issue of affordability we take very seriously. We took a 13.8% rate increase at the end of January of last year. We took another 2.6% increase in 25, and we've made great strides. The current estimate is that we're currently about 6% inadequate across the board, and we were about 20% inadequate from 2018 to 24. And if you take Baltimore City out of the equation, we're only 2% inadequate. But again, to get complete rate adequacy, including Baltimore City, would require some significant rate increases. Last year, this body passed House Bill 1098 that does a couple of things regarding risk-based capital and also created an affordability index, not an affordability index, an affordability work group led by the insurance commissioner. We participated in that work group. I felt it was very productive, very thorough, and we're looking forward to continuing the work and the collaboration on the issue of affordability. There are a couple of initiatives that we're working on. One is that we're looking to create a 6-month policy instead of a 12-month policy. So a shorter time frame is a lower premium and a lower down payment. So we think that in and of itself could incrementally help with affordability. We're also looking at trying to renew policies instead of rewriting a policy. Right now, if you're with us and your policy expires, you want to continue that policy, we have to treat it like it's brand new. And that includes not only a new application, but a new down payment. So we think that by offering renewals, that could help with affordability issues as well. And if you look at the the affordability work group, on the slide here, there are plenty of public comments regarding the importance of affordability, and that's not just a Maryland auto issue. That's across the board. And I don't have to tell you, you hear about affordability from your constituents every single day. But particularly in urban areas, it is significantly problematic, especially in those urban areas where there is not mass transit to fill the need for folks that need to get around. So finally, we are committed to progress. We're committed to getting closer to rate adequacy, and I'll point, as well as meeting our mission of looking at affordability. And to accomplish that, we're taking a multi-pronged approach to getting closer to rate adequacy. The initiatives are operational, they're regulatory, as well as seeking legislative initiatives. So, operational, we are an incredibly efficient organization. When our financial results come out at the end of the year, our general and administrative expenses will be less than 11%. I put that against any private company that's out there. We're very efficient. However, we're not done. Every dollar we save in operational cost is a dollar that we don't have to raise rates in low-income communities. We're working collaboratively with the Insurance Administration to identify regulatory steps that we can take to get closer to rate adequacy. And again, we're always seeking for legislative alternatives. And Madam Chair, with that, I'm happy to answer any questions that you and the committee may have.
I see a light. Thank you. Senator Washington.
Thank you, Madam Chair. There was well, thank you for being here. Thanks for the presentation.
Sure.
You know, when I was in college, I had MAIF. My bill was crazy high as a college student, but I guess it was more affordable than any other ones that were out there. So thank you for taking care of me on my college days that swiftly passed. I wanted to touch on a little bit about the affordability work group that you all set on. I know that others are going to come up here too to talk a little bit about it, but particularly along the lines of, you know, purpose of that was to look at affordability for automobile insurance. What I saw in preliminary reports, or the report that was just issued, that the can was kind of kicked down the road when it came to affordability with regards to areas or zip codes and how zip codes are used. There wasn't a vote taken on it. It was kind of just bypassed. Can you give me your opinion on the use of zip codes and whether or not they increase premiums for folks that live in more urban areas versus the more rural areas versus right next door? And how would you have voted as MAIF if that did come up to change it to make it more regional?
So that's a great question, and territorial rating impacts the cost of auto insurance. In my personal opinion, not speaking on behalf of MAIF or the work group or anybody else, that it affects everybody's car insurance. So if you are in an area, your cost is probably a little higher or lower than it otherwise would be based on the territorial rating. And I'll just give you a specific example. That's why all of us should shop our car insurance, by the way. But I grew up in Baltimore County and in an area called Perry Hall. And my zip code was 21236. Now, 21236 went along Bel Air Road, if anybody knows where Bel Air Road is. And it would go from Bel Air Road and the city line, which is inside the Beltway. And the story I'm telling, you can equate it to the DC Beltway as well. So it goes down to the city line inside the Beltway, and it goes out almost to Kingsville, which is a more suburban area. 60 years ago, it was quite a rural area. So if I'm using an insurance company and their territory is based on zip code, okay, I have the high cost of claims inside the Beltway that is being blended in with the lower claims outside of the Beltway. So me and Perry Hall, I'm paying more than I otherwise would because of those inside the Beltway claims. If you live inside the Beltway, you're paying less than you otherwise would because of the better experience outside of the Beltway. But all insurance companies are different. So if you shop around and you find one that has a territory that is more favorable to where you live, then you're gonna make money. You're gonna save money. The issue with territorial rating, especially as it relates to urban areas like Baltimore City, and we hear this all the time. The high cost of claims in Baltimore City is due to congestion. You know, if you got more people driving, you have more people going to hit stuff, and there's some other factors as well. But let's stick to the congestion, and there's a lot more accidents. And if I talk to a legislator from an urban area, they're likely to point out, well, the accident's occurring here, but we're not the ones driving. So if you, it's probably somebody from Senator Mounce's district. He's in the city. He's probably driving a tractor. He's in the city. He's not used to driving in the city. And you got one-way streets and all this. These are the folks that are causing the accidents. And we have pulled a little bit of data to suggest that to a certain degree, we see that, but there's not enough data, and we're a small player. There's not enough data for us to make a firm decision, but I think that's where the work group was going. The work group in a number of areas identified problems, had, as I mentioned, thorough and productive conversations. There wasn't a consensus as to what we should do today, but there was a consensus that we really need to look at this in a more detailed fashion.
Okay, thank you. But if you're saying that obviously having zip codes, and we hear from a lot of private entities, insurance companies that they use them from time to time, or some use them loosely here and there, but we all know they use them because even as you shop around as a customer, you're going to place and you change your zip code. In a second, your premium either increases or significantly decreases based on the area. And, I appreciate and I guess for MAIF, why did you vote to kick the can down the road, to not sit in a room to really iron this out, to come to a definitive answer, knowing that it has an impact on affordability?
So there was no vote to kick a can down the road or
Was
delay.
Was there a vote on the recommendations?
I do not. I don't recall. I don't remember a formal vote on a recommendation to eliminate territorial.
On the recommendations, just in general, was there a formal vote on all of the recommendations?
I'm going to defer to the commissioner.
The administrator said no.
Yeah, quite frankly,
The administrator said no. So,
but I think my point is that there was not enough on this specific issue. There's not enough data to make a determination what the impact on folks were going to be to the extent that there was a comfort level of moving forward.
of all the years of insurance companies using zip codes
Sure.
as decades of them using zip codes as a measure of affordability or cost, there's not enough data, from your opinion, to assess whether or not we should use that or go deeper into that?
Great question. There's plenty of data, and the data will tell you where the accident is, and it will tell you, how much the claim was and all that kind of stuff.
Yeah.
Where there is insufficient data is making the determination, well, where did the guy that caused the accident, where did he live?
But that's just one piece of the data.
Yes.
That's that's one piece and
Sure.
one small piece of the data with regards to zip codes. Let me just ask you a question about MAIF. How does MAIF use zip codes in their
So we
determination?
we have zip codes, and then we group them together to have group rating areas. Because one of the things you have to do from an actuarial perspective, it's difficult creating rates when you don't have enough data. So I'll give you an example. We might have a zip code where we have 2 policyholders there. Well, you really can't create rates on the information of a geographic area just based on 2 people. So we lump that into different areas, and to get a bigger pool of information, of data to make those decisions.
Yeah, no, I'll leave it at this because I'm not getting the answers that I really want. And you and I have met many times. You came to my district, you and your
Yeah.
Colleague here, and so we have a really great relationship and have been working well together. So I appreciate that dialogue that we've had. Using these zip codes have been a barometer of telling Black people and brown folks when they live in a certain zip code, the auto insurance premium is higher. When you live in a more predominantly white community, your insurance is lower. studies have suggested that the data is there and it's clear. And for this affordability work group to not take that on as an issue and not come up with a consensus or to really, because you don't really have to come to a consensus for everything, but we know this is a topic that insurance industry does not really want to talk about. And so that's why it wasn't a real consensus. And so I'm drawing concerns around that. And I think that as MAIF, as one of the most, as your title says, affordability, I would expect for you guys to have a full opinion and write on it and talk about this because it is really distinctive when it comes to Black and brown people in our areas where we know that the cost of everything has increased significantly, including when you move in these areas or you try to incentivize people to move in these areas to have your insurance rate increase because you want to move into these areas. It makes it unaffordable for folks that want to live there. And for this work group to kick it down the road and not come to a consensus or not to just make a recommendation to the General Assembly about where they should be. Just disappoints me in seeing that. So thank you for being here. And thank you.
Thank you. Appreciate the feedback.
Thank you, Senator. Do I have any other questions for Mr. Redmer or Devon? Okay. Is this the end of your presentation?
Yes.
Okay, so now we're going to have...
Although you know I can go on for another half hour, so if you'd like.
Oh, I know you can. I know you can. So now we're going to have the insurance commissioner, insurance administrator back, Commissioner Grant, and she's going to bring Joy Hatchett with her, and I think they're going to address the affordability study and the telematics, right?
Absolutely.
Thank you.
Thank you, Madam Chair. It's just me today. Deputy Commissioner Hatchett is preparing for this weather that I think we may be experiencing. There are insurance implications for all of that, and so she sends her regrets. So, good afternoon. Again, Marie Grant, Maryland Insurance Commissioner, here to talk today about a few important issues. First of all, I think we want to talk about our view about Maryland Auto, what we're seeing in terms of finances and the progress towards adequacy. We're going to talk about that work group study and report on the affordability of private passenger auto insurance in Setter, Washington. Happy to discuss. I'd like to respond to your questions at the appropriate time as well. We're going to talk a little bit about rate and underwriting trends we're seeing in the private passenger auto market writ large, and then provide a little bit of an update on the telematics report that we did last year. So, Maryland Auto, I think, as you've just heard, I'll try not to repeat things that Executive Director Redmer has already shared, but it's a quasi-governmental agency. It's established under Maryland law to provide auto insurance to high-risk drivers who cannot obtain coverage through the private market because of their risk. They need to be turned down, I believe it is by two auto insurers before they can apply for coverage to Maryland Auto. And I think just as we talk about affordability and risk, those are two issues that are really important to keep. I think they're a little bit separate in our minds. I'll talk a little bit more about that in detail. As of December 31, 2025, there are about 32,000 members in MAIF. That's been a 29% drop in the past year. But it doesn't represent Maryland Auto's lowest enrollment. And I think as you saw from that great chart, it really has fluctuated over time depending on what is happening in the private market generally and the underwriting appetite of our larger private market. When Maryland Auto's year-end surplus drops below a certain amount that's set in statute, it accesses funding through an assessment on the rest of the market to ensure its solvency. And how that works is if their surplus drops again below a certain amount, there is an assessment charge collected. There is sort of an attribution of the assessment by private carriers in the market. And then they can, and frankly often typically do, pass their portion of the assessment on to policyholders as an assessment surcharge. So over the past several years, we've seen steady erosion of the surplus, primarily due to rate inadequacies, and I'll talk a little bit more about that. There was the first assessment this year in I think decades, almost 40 years, of $19.4 million. Another assessment is going to be issued this year. As Executive Director Redmer mentioned, it's likely to be lower. But we're probably in a situation where if nothing else changes, there will be an assessment in 2027 as well. And Maryland Auto is regulated by us, and its rates are subject to review by MIA. But I want to just pause here and talk about, just remind folks how we review rates in general for property and casualty. Generally, they are file and use. Generally, we are looking at rates that are inadequate. We want to make sure companies can pay their bills and their promise to consumers. Excessive, that is above what is actuarially justified, or unfairly discriminatory. That is, this is a market where there's a lot of rating on risk. If it is looking at something that is prohibited by law or does not have a sound actuarial basis. And I'll talk a little bit more. We made some changes to how we're taking a look at Maryland Auto's rates as part of last year's legislation. So Maryland Auto uses an affordability index to cap the liability base rate for minimum legally required coverage at 3.3% of the median household income in certain zip codes. And so what that means is they are doing territorial rating based on zip codes. But for those zip codes that may have high risk, they are capping the total amount at a certain percentage of income. So in December of 2024, we issued an order requiring Maryland Auto to phase out the use of its affordability index. I just want to state again, that's not because we think affordability is not important. We absolutely do. The challenge that we have with Maryland Auto's rates is that they are not adequate. Their losses are bigger than what they are taking in. And just out of a matter of principle, we believe that that rate filing is in violation of Maryland law. So in March 2025, we amended that order. We extended the grace period. We recognized that it was going to take time and there would be challenges in needing to be a phased-in increase of phased-in increase in associated use of the affordability index. So right now, under that order, the affordability index is required to be phased out by December 31, 2027, and a plan is due for phase out by March 1 of this year. All right. This is, I'm sharing a similar chart to what Maryland Auto shared, but we also added in budget for year-end 2026. And this is all data that we've received from Maryland Auto. There's a lot of unknowns. Oh, thank you. Thanks for the zoom in. A lot of unknowns for what 2026 holds. I think there's a lot dependent on, as Maryland Auto talked about, the actions of the private market really does impact Maryland Auto. But right now, we are on track for a net loss with Maryland Auto in 2026 of about $19 million. And most likely, unless things change, we're looking at another assessment. I also want to highlight here one of the line items in Maryland Auto's budget is commissions paid. Right now, statute requires them to pay at least 10% for a policy. I understand there may be consideration of addressing that issue, but that is a fixed line item that could help if they are able to restructure their commission policy. This slide is about the assessment and how it broke down to our other carriers. Again, we expect to be issuing an assessment again this year. Projected, at least currently, we'll need to wait till closeout for the exact number, but at least currently that looks like it'll be about $15 million. And we do anticipate, again, based on those 2026 numbers, current projections, that we'll be looking at another assessment in 2027 unless things change. Okay. So this is a little bit about the order I mentioned. And Maryland Auto did file for a rate increase with us this year. The overall indicated rate change, that is what the actuaries said was needed to get to adequacy, was an overall 8.6%. The overall filed change was only 2.8%. For liability coverage, the indicated rate change was actually 11%. Filed rate change was 3.1%. And the primary reason for the difference between indicated and filed was Maryland Auto's suppression of the rates in those zip codes subject to the affordability index. For physical damage coverage, the indicated change was negative 2.3 and the filed change was 0.2. So I think in addition, Maryland Auto did make some changes to the affordability index in their summer filing and how they're using it. They reduced the number of affected zip codes from 50 to 47. They increased that liability base rate cap from 2.9% to 3.3%. And increase the permissible maximum rate change per zip code. So it's our view that Maryland Auto is currently in compliance with our order. They have made progress. They did recently submit a request to us to further extend the deadline to come into compliance with our order to the end of 2028, and that's something we're in the midst of reviewing right now. So House Bill 1098 from last session gave us some more tools to proactively regulate Maryland Auto's financial condition going forward. It subjects Maryland Auto to RBC, or risk-based capital surveillance system, that applies to other insurers and requires them to maintain a certain amount of surplus. Requiring a company, and why insurers have surplus, is to protect them from the volatility of the world, essentially. Like, we want to make sure that they are able to pay claims when needed, even if conditions do not follow the usual course of the world, which often they do not. So it also subjects Maryland Auto to prior approval rate-making standards starting last year. And when its surplus level is below the prescribed threshold. And so it essentially gives us more authority to make sure that we are moving on the path towards adequacy in accordance with the order. So again, this is a little bit more about the bottom line, but at the end of the day, we think Maryland Auto will continue to be subject to prior approval rate-making standards if nothing changes, and it's looking like there may need to be an assessment in 2027. So I want to turn from there to the situation with Maryland Auto. And maybe before I turn from there, I think as a regulator with Maryland Auto, they are subject, it is our view, we've talked a lot about affordability. There is nothing in Maryland law that says that Maryland Auto needs to also look at affordability. I think it's a fundamental difference in opinion between Maryland Auto and ourselves in what is authorized. I also want to say that is a policy call that is in the purview of the legislature. The role of Maryland Auto, how the affordability index would continue or not continue. Again, it's my view under current law that it is not authorized. That is not to say that it's a policy call that is above my pay grade, essentially, as I move to talk about affordability and the auto insurance market more generally. So that same bill, House Bill 1098, created a work group. It was a small work group, and it had a variety of charges, possible ways to define affordability in the context of considering insurance premium rates, factors impacting affordability of insurance in the state overall, options to enhance transparency surrounding insurance rates, how affordability can be considered in establishing insurance rates consistent with those rate-making principles I talked about in the insurance article, and then the financial status of private passenger auto insurers in the state and options to address excess profits by those insurers. So this was a wonderful group, small group, with some very different perspectives, right? So I did chair this work group. Executive Director Redmer served on it, Senator Guile, Delegate Fraser Hidalgo, Nancy Egan from APCIA, Marceline White from Economic Action Maryland, and then Michael McCartan, who is a broker, an independent broker for private passenger auto. So we held 4 virtual meetings. Once we got our appointments, we were off to the races. And we held 4 virtual meetings, which were open to the public. And we took feedback from public stakeholders, including consumer advocates and members of the insurance industry. All of that was taken in and considered by the work group. We also looked at laws and regulations adopted by other states, information published by the Federal Insurance Office, briefings and reports by nonprofit research organizations, data and recommendations from the NAIC, and then aggregated information reported by insurers in rates and filings and financial disclosures. There is the work group report, which is very comprehensive, and recordings of our meetings and all our meeting materials are on our website. So I'm going to talk about areas, so just to back up, we did not take a vote on any of these topic areas. This was a small work group. On many issues, it was going to be clear that there were going to be some pretty stark differences of opinions, and we had a very short time to produce a very comprehensive report. So what we did is we tried to find where recommendations had consensus, and recommendations didn't have consensus. But we outlined, I think, everything that we talked about, no matter what, whether we had consensus or not. One of the areas we did have consensus around is further study of how the legislature could establish an equitable and sustainable low-cost auto program. There are a handful of other states that have various forms of programs that serve folks who cannot afford the cost of auto insurance. We have a mandate to purchase auto insurance. It's something that I think it's really important, and I think the work group members thought was important and that we really take a good look at. So we do have departmental legislation coming that will have further study of how we could do that. There were some consensus recommendations that can be implemented administratively and don't need legislation. So one of them is that we as an agency are going to periodically report on the Federal Insurance Office's affordability index metrics for Marylanders for private passenger auto. So that index expresses the average cost of auto liability insurance in zip codes that are low income or have a majority minority population as a percentage of median family income. I think this is for transparency. We should better understand and have visible the costs of auto insurance across our state in low income and majority minority areas. We also, we do annual reports to the legislature on the overall financial, or let me back up and say we have reporting that we send to you already. We're going to add to that the overall financial performance and underwriting profitability of auto insurance in the state of Maryland. For Maryland Auto, as Executive Director Redmer mentioned, we talked about a consensus recommendation being lowering the length of policy terms from 12 months to 6 months. We think that can be done administratively. We think that's a good idea, and the work group thought so too. I am pressing the button, Tammy, but, oh, there we go. Just taking a second to catch up. Hold on, let me make sure I know where I am. Okay, so we also recommended further looking into updating DPSCS's system about connecting with online insurance verification, enabling officers to better accurately identify instances where a driver may be driving without insurance. Towing and post-towing procedures were identified as an area that needed further examining as a contributor to costs in the auto market. And then also whether Maryland's graduated licensing and traffic safety laws needed to be addressed to further reduce the frequency of collision claims. Okay. So moving on from there, actually, let me just pause and say, before we leave the work group, just because an issue didn't have consensus doesn't mean that as a regulator, I don't think it's an important issue. And I want to say territorial rating is one of those areas that I think is a really important issue. One of the things we talked about as a work group were other states' examples where there's very clear guidance to the law to insurance departments to either rules of the road for territorial rating, or, for example, in Connecticut, there is longstanding policy where zip codes have a blended rate of the actual experience in the zip code and the statewide experience to try to accommodate for commuting and things of that nature. So those are things that I think are going to be critically important that we as an insurance administration are going to continue to look into. So just in general, what we're seeing in the market overall, 2023 and 2024, we had significant rate increases in the private passenger auto market, but rates are leveling off. And in fact, we're even seeing decreases in some cases. In 2025, we saw a sharp drop in the percentage of carriers taking rate increases. 32% took a rate increase, 20% took a rate decrease, and 48% filed rates that were rate neutral. As opposed to 25, back in 24, we saw increases up to 24.2%. In 2025, among top 10 carriers, the largest rate increase filed was 3.5%. And then the largest decrease was of 15%. So we're also seeing an increased look in underwriting trends using outside information to price policies in a more targeted way. That's something we're keeping an eye on. We also posted draft regulations on our website for feedback requiring affirmative submission of underwriting guidelines within the next year for both home and private passenger auto. Those are regulations. We've received a bunch of feedback, but those are regulations we intend to pursue. All right, so my last topic is telematics. In July, we released a report summarizing the results of a survey to our top auto carriers, about 81% of our market that reports online. In 2023, about 13.23 of policies in Maryland were some type of usage-based or telematics policy. And during that same year, we saw about 31% of those enrollees experience a rate decrease. 23.6% experienced a rate increase. Most folks experience no change in premium at the time of renewal. Surveyed insurers identified more than 40 different data elements that are measured through these programs. So just benefits and concerns with telematics programs. So some of the benefits, and I think the idea and the goal is to more accurately measure risk. And so these programs collect real-time data about individuals driving that can enable insurers to develop more personalized and accurate risk assessments than traditional methods. That's the hope and the goal. They can also provide feedback to help drivers identify and correct risky behaviors. It may be helpful for folks who aren't driving often, who aren't driving typically in congested areas, or are consistently just really good drivers. They may receive premium rate reductions. And there's also cases where that data might simplify and expedite the claims process. But I think concerns that we see as a result of this survey, the primary reason folks want to enroll in usage-based insurance or telematics is to save money. But at least what our survey saw was that there was only a little less than a third of a chance that enrollment would actually lead to a premium decrease in 2023, again, based on our data. And we've also seen complaints about telematics-based rate increases. So about 12.4% of all of our private passenger auto-related consumer complaints between January 1, 2024 and June 30th, 2025 were related to telematics rate increases and a wide range of factors relating to those increases. So that's the end of my presentation about all things auto insurance, and happy to answer any questions you have.
I think Senator Washington's going to have questions.
Thank you, Madam Chair. Madam Administrator, thank you for being here. I got to say, you're one of my favorite secretaries in the cabinet, and you've been doing really. I'm just saying, that's the truth. You didn't ask me to say that, but I do think that. I think your staff is amazing as well.
Oh, thank you, Senator.
And that's not because you and I work together on telematics this year. But thank you, and I just want to let the record reflect that insurance companies do great work. And I believe that insurance companies are necessary for people that have serious injuries and things that happen in this state. My goal and the comments that I'm making and the bills that I produced are merely because I want it to be more affordable for Black and brown people that live in a certain area where I know that the insurance premiums increase significantly. And I'm going to ask just a few questions of you.
Yeah, absolutely.
And one, this work group, can you just tell me the work group that was created, how was it created?
It was created through legislation.
Okay. Now, it was created through the legislature, the affordability of private passenger automobile insurance work group. Is that right? Mm-hmm. Is it also true that you all, when you made your recommendations, that you only made recommendations that was of a consensus to that work group?
So everything in that report, we went through each topic by topic, and had discussion and talked about where we could get to agreement. In areas where we couldn't get to agreement, all of those topics were still robustly covered in the report. So.
Covered, but the recommendations that you made through this report are based on consistency only, right?
That's right.
You all agree.
Consensus recommendations, areas where we couldn't meet a consensus were discussed, but didn't have a recommendation.
Correct. In the legislation, did it make a direction for you guys to only make recommendations that are only agreed upon by all of you in that work group? Did it make that? Was that one of the lines within the legislation, that you only can propose recommendations to the General Assembly based on you all agreeing?
No.
No. Why was that chosen?
It was chosen because I think, given the small nature of the work group and the clear division on many issues, that it was just not going to be. It wasn't going to serve the time we needed to make the deadline of the report, and so I think that was just a choice that I made as chair. Senator, I do just want to say too, because I've heard about the questioning earlier, and I know some of the issues that both you and I care about a lot. That wasn't a decision to not have discussion about those issues. Those issues are still incredibly important. That doesn't mean we're not going to continue to discuss them, but it was really to expedite and move along the work.
With all due respect,
Yep.
we've had many discussions on this topic. We created this work group, at least I voted for this work group, in the hopes and a pullback on pieces of legislation with regards to territorial rating, because we had this work group, and in the hopes that you all will give us an opinion, whether it's consensus or not, where we should go. And give us that direction, because in this work group are the professionals, and we lean on the professionals to give us opinions and recommendations. And for this to be something that we've discussed for multiple decades here is just disappointing to the folks that live back at home. And, you know, I'm gonna go back to my questions, because I appreciate your thoughts, and you do me off a little bit trying to get me. I wanted to see some recommendations, and for us not to have recommendations.
Yeah, I hear you. I definitely hear where you're coming from.
And for you, you know, in the administration, you also said that it's something that we should continue to discuss. Now, knowing that the rate increases in these Black and brown areas, and that they are studies, independent studies that show that these rates increase, how much of it is a priority for you to take this on if this work group already kicked the can down the road?
It's a priority. So let me just say, in my first year in the insurance administration, in property and casualty, the focus has really been getting our staff up to speed. So when I arrived, there was one actuary. Now we have 5. I think, as I talked about earlier with rates in general, we have a file and use competitive structure to how we do rating, but we're asking harder questions this year as the rates come in. And so that is really, Senator, I think the first step of moving towards some more careful looks at some of these issues. I think the issues you're raising, and there's 2, and I just want to say that both of them are concern to me. I think the first is our current system of rating discriminating? Is it accurate, right? Is that zip code rating accurate? That is something that it is my plan to do a deeper dive into with our team in 2026. That's the first thing. But then the second thing, and I think I hear you questioning, and I agree, are we doing it in a fair and equitable way across the state? And that's something that I think we will develop opinion on over the course of the year. I will say sometimes I'm going to move more slowly on issues. I do like to be deliberate. I like to really understand the data and the ramifications and the impact, but I am dedicated to looking into this issue. I care about it very deeply. And maybe just as I live in the suburbs just over the city line in Baltimore City. I drive through Baltimore City every day, and the inequities in zip codes and access is something I literally am faced with every day, and I feel an obligation to do something about.
Timeline when you're gonna do something for this particular topic? And the reason I ask that, because a lot of the work recommendations say that it shall continue to study this issue.
Yeah.
We recommend to continue to study it. Okay, study it for how long, and then who's responsible for those studies?
So this work group looked at territorial rating, as was the charge. There wasn't consensus. We are going to continue to look into it as an agency, and would be happy to give you updates on it as our progress unfolds.
On this topic, let me ask the last question. Should one of the recommendations be to extend this work group so that you guys could come up with a actual solution for this particular issue, or any other issues that you kicked down the road?
So that's a great question. I'm not sure that we discussed it as a work group. We were really trying to meet the concepts addressed in the goal, but I think that's an interesting question and certainly open to discussing more.
Got it. Now let me go to my favorite insurance company, MAIF. I'm joking. Maryland Auto, you've asked them to increase their affordability rating or their rating
To phase it out.
to
Yeah.
phase it out. Can you just tell me how is that going to affect the folks that are on that insurance? Like, will their rates increase? And do we know by how much it would increase for those folks?
So Maryland Auto has better information there. My understanding is that some of the rates could be substantial. In part because Maryland Auto, like I think frankly, every other auto insurance company that I'm aware of, uses territorial rating and does it on the basis of zip code, right? There are other ways to solve for that rate impact. But yes, if Maryland Auto wants the business practice of continuing to use territorial rating and zip codes, if they are phasing out the affordability and index, some of the folks in those zip codes could see considerable increases over time. And in fact, that's why we talked about phasing it out, recognizing the disturbance in the market, but seeing that the rates continue to be inadequate.
Would that make them also less competitive to these other insurance companies if they were to phase that out?
So it could, but Maryland Auto is not supposed to be competing as it's currently designed.
Well, it's an option to be more affordable option. Is that right?
It is not.
Okay.
So it is really for higher risk drivers, and I think even with the affordability index, it's still often that rate can be considerably higher than the private market.
Got it. So they will see an increase
If they continue on, but I think
the insured
Right.
will see an increase in their premiums once this gets phased out.
Yes. But Maryland Auto would also have to provide, it's not designed to be a solution for folks to stay on, as in your case, forever. It is something folks enroll in, and as their experience gets better, they often go back to the private market.
No, I'm not on them now. I don't use them. But back in the day, yes. Thank you very much for answering my questions.
Thank you,
I really
Senator.
appreciate it. And again, this issue of territories does need to be studied, and it has been studied, and kicking the can down the road, to me, is unacceptable for a work group that was told to me and others that it would be brought up, and it would be something that would be taken seriously. And we were hoping for a full recommendation from the professionals in this industry so that we can make a sound solution here in the state to help drive down the cost for these communities that are experiencing high premium rates. So thank you.
Thank you.
I'd like to add a little something if I can, because I have a little experience in this
A
market.
little bit.
So often when people go into the Maryland Auto Insurance Fund, it's because they didn't have prior insurance, or they allowed their their commercial insurance to lapse. And so after they spend time in the Maryland Auto Insurance Fund, either 6 months or a year, but they develop insurance history again, they can go back to the regular market. So no, was not meant to be the affordable market. It was meant to be the alternative market when you couldn't get, other insurance. And so hopefully in most cases, it's sort of the training ground until they can be moved back into, the regular market. So I know there's a lot of confusion about it being the affordable market, but it's really the inexperienced or the driver that doesn't qualify otherwise because of violations or accidents. So I think there's some misperception about why we have Maryland Auto Insurance Fund. But thank you, and I have a question for my vice.
You might have just answered it. No, to the chair's point, I think I'm perplexed by that as well. To Senator Washington's point, I think at one point in time when I was less responsible, I would use MAIF. But, and you would imagine, especially because a large portion of the population that use them because they can't get insurance by anybody else would be young people that's starting out because they're in that high-risk category. And so I always struggle with the balance between, affordability. I think the chair just articulated a lot better than I can. But that balance, I feel like should be afforded, especially to people that's starting out. And especially because it's supported by like the state or the government, which is unique to the other insurers. If we're going to be providing some type of subsidy for it to even exist, that affordability should be there somewhat. But I being on this committee, I've learned a lot more about those differences, but I struggle with it.
Yeah.
And so, but also want to articulate, I've also in the past introduced bills around, I was just sharing with the chair, how my insurance literally doubled. I live in a way more residential, less dense area in the city. And it's been frustrating to a lot of city residents or whatever, as it may happen. The only other thing that, and off of auto, I'm switching from auto insurance a little bit, just homeowners insurance, especially as it relates to multi-family dwellings. I'm starting to hear more and more concerns about the ability for multi-family dwellings to secure, insurance, and I'm curious, and mostly because I think a lot of their underwriters or whatever are somewhere in New York, somewhere, not really local. But is the administration hearing from individuals about concerns about not being able to acquire insurance in that area?
So I've heard, Mr. Vice Chair, I think maybe just like you, sort of in conversations, I've heard folks ask and have concerns. I have not seen formal complaints, though, and formal outreach to us on this topic. So I think anything that you're hearing from your constituents, would love to make sure it gets to our folks so that we can talk about it.
Yeah, I know there's a couple of advocacy groups or organizations that represent multifamily. So I'd be curious and interested in probably just having a conversation about what people are experiencing.
Absolutely. Absolutely.
Because again, it goes to the affordability of housing if people can't get access to insurance.
Yeah, absolutely.
Thank you, Madam Chair, and thank you, Madam Bishop.
Thank you.
Do we have any other questions for our insurance commissioner? Seeing none, thank you again for your work.
Thank you.
I know it's not an easy job, but we really appreciate it, especially in the healthcare area. So thank you, Marie.
Yeah, thank you so much, Madam
Have a
Chair.
good afternoon. We're going to take about a 2-minute break while our manager sets up for our bill hearing.